Hello and welcome to Critical Accounting, a full university-level course that will teach you everything you need to know about financial accounting and financial statement analysis. This course is unique because it not only teaches you the basics of accounting, it teaches you to think critically about accounting. My name is Cameron Graham, Professor of Accounting at the Schulich School of Business in Toronto, Canada. Throughout this course, I'll be teaching you a challenging way of looking at accounting. Accounting is not just about reporting the financial performance of an organization. It actually shapes the entire world that we live in. Accounting is behind every product, every service, every government policy, and every story of the rich and poor. Accounting is a tool of persuasion. If you want to understand how corporations use accounting to convince you to see them in a particular light, this course is for you. Now, on with the first lecture. I'm going to start by looking at Apple. It's a company you're all familiar with, which is a good place to start. You want to have some familiarity with what the company is about if you want to understand the financial statements. And I think everybody gets what Apple does. So I've got a question for you. What did Apple do in 2016 that it had not done for 15 years? The answer is that its sales dropped from the previous year. If you can see from this graph, Apple's revenue from 2001 onwards, you can see how dramatically it grew during the first 15 years of this century. And then in 2016, unexpectedly, the sales dropped. So what we're going to do today is we're going to look at Apple's 2015 financial statements to see if there's any clues as to why this might have happened. So here's what we're going to cover. We're going to look at Apple's income statement, balance sheet, and cash flow statement to give you a general overview of what those statements are about. I'm going to try and give you an idea of how to read these statements, what you can expect to find on them, how to understand the information that's in them, but also to understand how they're connected to each other. And along the way, by developing some questions about what's going on at Apple, I want to help you learn to think critically about what these financial statements say. So if we want to understand why Apple's revenues dropped in 2016, it's probably helpful to stop and think a second about what it is they actually sell. What's your favorite Apple product? If you answered iPhone, you are amongst a large group of people because Apple's revenues are dominated by iPhone sales, 2/3 of the revenue in 2015, and that has not changed very much in the last few years. These figures are pulled from the Apple financial statements. We're going to learn in class how to look for detailed information. You won't find this breakdown of the sales by product category in the financial statements themselves. You have to go looking in the notes to the financial statements. And that's one of the things that's going to be a feature of our course is digging into the notes to look for more details. But as you can see, Apple's iPhone sales are dominant. They have about 10% each for Mac, which is all their computers, iPads, which is all of their tablets, and then their services at about 9%. And everything else is minuscule. So the large majority of their sales comes from the iPhone. So there's a bit of a concern there, perhaps, that they are a one-product company. And to a certain extent, I think that's a fair criticism. Apple has been known as a computer company, but it's really a cell phone company these days. Here's one of the other concerns, is that the iPhone was launched back in 2007. So in 2015, the product was already 8 years old, and it's several years older now. The other big hitter for them is the iPad, which was launched in 2010. These two big products that people associate with the innovation and the product styling of Apple are quite old. And of course, the Macintosh computer goes back to the 1980s originally, and the iMac, I guess, early 2000s. All of these products are fairly long in the tooth. And that might be a bit of a concern for Apple aficionados because it indicates that all of their revenue depends on fairly old products. So we're going to look at the income statement and see what we can find out about Apple's profitability and where its revenue might be coming from. Here we have the income statement for Apple for 2015. And the very first thing that you'll notice is that the statement is called the statement of operations. It's not called the income statement at all. So there are many synonyms for this particular kind of statement: the income statement, statement of operations, profit and loss. All of these mean the same thing. You notice the word consolidated up here. That simply means that Apple is a large company with a whole bunch of subsidiaries. one for every country in which it operates, more than one, in fact. In any country, you'll have a subsidiary for intellectual property, for product development, for warehousing, for sales, and so forth. And all of these companies from around the world that all belong to Apple are consolidated together, added together to produce the statement that's in front of you. The columns are labeled by the year end. The company has an end of September year end rather than an end of December year end. And it has also got a particular day of the week as its year end. Why does it do this? Well, as a retail company, Apple probably has one day during the week that is heavier sales than others. It might be Saturday, for instance. And it wants to make sure that it includes the same number of Saturdays in each fiscal year so you can get a proper comparison. If it went with a September 30th rather than a September 26th, 27th, 28th year end, then you would end up with a different number of Saturdays or a different number of Fridays or whatever is their heavy day, a different number of those in each of the fiscal years, making the comparison a little bit more difficult to interpret. All of these numbers are in millions. So the very first figure that you see there, 233,715, is actually 233,715,000,000. So all of these numbers are in millions. In a smaller company, it might be in thousands. Important to know. The statement is organized as follows. It starts out with your net sales, subtracts the cost of sales to give you your gross margin. That's the very first calculation that you're given. So the net sales, the word net simply means that you've got all of the sales during the year minus the returns. If a retail customer or a business customer returned product to Apple, that would be deducted to give you the net sales figure. The cost of sales includes all of the parts that went into the iPhone, for instance, plus all of the labor to assemble those. And more than that, it's also got, the cost of the packaging, the cost of shipping from the supplier to the warehouse of the company through to the retail store. All of those things would be the cost of putting the product in front of the consumer and making it ready to purchase. So what does this give you then? It gives you, out of the $233 billion worth of net sales, it gives you a gross margin of $93 billion left over for running the company. So what did it cost to operate that company? The total operating expenses are $22 billion, giving you an operating income of 93 minus 22 is $71 billion. What's curious about this operating section is the breakdown that Apple has here. It really only divides its operating expenses into two categories. Research and development is the one that it wants to highlight, and everything else is other. Selling, general, and administrative is just a complicated way of saying other. The research and development is highlighted here, I think, because Apple wants you to know just how much it spends on research and development. It has almost doubled its expenditure on research and development in the last 2 years, and it feels that it's something worth highlighting. As a technology-intensive company, as a company that prides itself on innovation, this is something that it wants to make sure everybody sees front and center on its financial statements. The next section is other income or expenses. What do we need to know about this? Well, first of all, it's not related to operating the company. So these are other expenses and income that had to do with other aspects of the overall legal entity of Apple, but had nothing to do with actually running the company that you think of when you hold an Apple product in your hand. Other income and expenses might include gains and sales on investments in the stock market or what have you. One of the things that is worth looking at here, I just want to highlight this. You've got this word expense in parentheses. So if you look at the numbers to the right, all of these numbers are positive numbers right here. And what that indicates is that they are other income. So when you add together all of these other things that happened at Apple outside of its operations, they all came to positive numbers or income. So if you saw here a number that was in parentheses, it would indicate that the net number was an expense for that year. So in each of these years, thankfully for Apple, all of its other expenses came to less than all of its other income, and you ended up with a positive number. The final section here then is the provision for income taxes. And you'll notice this word provision is quite important. This is not the amount of income tax that Apple paid to the government. It's the amount that it set aside in its accounting books as a provision for income taxes. So this might be a number that it spends later on as those income taxes actually come due, but they're the income taxes that apply to the sales during this year. So that's why the word provision is there. It's simply saying that this is the economic significance of the income tax, regardless of what year it actually remits that tax to the government. So stepping back then for a second and looking at the overall picture here, the comparison of the 3 years gives us an understanding of what's happening at Apple in terms of the profitability of its operations. We can see that there's been a tremendous increase in 2015 in its net income, jumping from 37 and 39 in the first 2 years up to 53 in 2015. This would indicate you'd think that the future was very sunny for Apple, making the conundrum of its drop in sales in 2016 even more interesting. So we have an increase in net income. What we want to do if we're going to think critically and analytically about these financial statements is to try and figure out what are the factors that are driving this increase. Obviously, the place to start is the net sales, and you can see that there was a large increase in net sales from 2014 to 2015, matching the growth in net income. So clearly, Apple is making more net income because it's selling more product. But let's try to figure out what's going on behind these numbers. So let's look a little deeper into the revenue figures for the company. You can see that these numbers down at the bottom here match exactly the figures from the top line of the income statement of the company. So what Apple has done, and this table comes in the notes to the financial statements that you'll learn to dig through in this course. What they've done is they've taken these figures and they've broken them down for us by the region from which those sales came. And so that table on the left comes from the notes. The two tables on the right, the common size and the trend, are calculations that I've done with those numbers. One of the things I want you to learn to do in this course is to take the numbers to the financial statements and use them yourself to recontextualize them, to compare them against each other. The easiest way to do that is to key the numbers into a spreadsheet and start doing calculations with them. And that's what I've done here. I've got two sets of calculations. I've got a common size and a trend. The common size simply takes the numbers and does a vertical comparison. So it compares the $93 billion figure to the total at the bottom, and it compares the $50 billion to the total at the bottom. And in each of these columns, then it calculates the percentage of all of the numbers compared to the figure at the bottom. Now, the trend analysis is a little bit different. It does a horizontal comparison, often called a horizontal analysis. So what it does then is it takes the numbers and compares them to the earliest figure. So you're taking 93 divided by 77, then you're taking 80 divided by 77, and then you're taking 77 divided by itself to give you the figures that are shown on the right. So what do we learn from these? The overall picture then of growth for Apple is that it grew by 37% over 2 years. Now keep in mind, this is not a comparison of one year to the previous year. It's comparing all of the years to the earliest year. So that's 37% over 2 years. So that's the overall growth of the company's net sales. What was really driving this, if you look carefully, there's one figure here that stands out above all the others. And that's this figure here. This line is China. China grew by a factor of 2.17, so more than double the sales in 2 years. So compared to the overall growth of 37%, this is a doubling of sales in China, indicating the importance of and the growing importance of China to the sales of Apple. And we can also see this revealed in the common size analysis. You can see that China grew from 16% of the total sales in 2013 up to being a quarter of the sales. So this indicates to us that the growth in China is very, very important to Apple from 2013 to 2015, but it raises the question of whether this growth will continue because it's clearly a very, very important part of the strategy of Apple to expand into China at this point. There's another curious thing about this table that I just have as a question off to the side for myself. Um, what happened to India and Africa and Russia on this table? Those would be fairly significant product regions or sales regions. They don't show up on this at all. Like, Russia, I presume, is maybe lumped into Europe. That makes a certain amount of sense. But where is India? Is that in Asia Pacific? I don't think of India as being part of the Asia Pacific. And for goodness sake, where is Africa? It doesn't show up on this chart at all. Okay, so what have we learned? We've learned that net income is rising mainly because sales in China are rising. So that's what's driving that figure. Is there anything else that's driving the increase in net income? Let's look at the cost of sales next. This is taking the statement of operations. And again, I've keyed it into a spreadsheet so I can do a little bit of playing with it. And I've got my common size analysis here. So what do we see here in terms of the cost of sales? Obviously, the cost of sales in raw terms has grown dramatically from 106 billion to 112 to 140 billion. But one of the things the common size analysis tells us is that in relation to the net sales, cost of sales has actually dropped. So this is going to cause an improvement in the net income for the company. So net income is rising not just because the sales are growing, but because the cost of sales is declining in relative terms. Why is it declining? Let's have a closer look. Well, let's just stop and think again about what it is that Apple sells. How many Apple products and services can you list? If you're looking at this video with a friend, you might want to just stop and each of you draw up your list of all the products and services you can think of that Apple sells and compare them. And here's the list that I have got, which I got from their financial statements. You have the iPhone, iPad, computers, Apple TV, Apple Watch, Beats headphones, iPod, and all their accessories. And then you've got all the services, which includes iTunes or what's called Apple Music now, the App Store, iBooks, Apple Care, which is their maintenance plan, warranty service, Apple Pay for commercial transactions like a credit card, and of course, all of their licensing. If they license products or logos to other people, they earn revenue on that. So this is all of the products and services that Apple has. This gives us an idea of just how complex their revenues are. So what's included in the cost of sales? I won't make you guess. Let's just look at this. For the products, you're going to have all of the parts, of course, and the assembly, the labor that it takes to put them together, packaging and storage. So I mentioned that earlier. In terms of services, there's also cost of sales. So all the wages to the people who, for instance, run the servers and web pages and stuff that Apple relies on for a lot of its commerce. The iTunes products that you rent don't come for free for Apple. There's a tremendous costs involved in creating a website like that. So all of the wages and all the information technology that are necessary for those services would be included in all of those. If you're talking about the Apple Care program, you're going to have to pay actuaries and lawyers to draw up all those contracts. So all of that stuff is the cost of these services. So the question then is, what changes has Apple made over the past 3 years, from 2013 to 2015, when we're looking at the statements we're looking at? What changes has Apple made that would have reduced the cost of sales? If you think about what was happening at that time, you'll come up with a bunch of possible answers. There might have been engineering improvements, just to make it more efficient to build and assemble the product. It might come from power over suppliers. One of the things you need to recognize is that accounting is about power. It is about the ability to dictate terms to other entities. It is about the ability to control the story that you're telling about the company. So in this case, having power over the suppliers and being able to force them to produce sub-assemblies and so forth, that kind of power would give Apple the ability to squeeze down the cost a bit and save them some money in terms of their cost of sales. Might also come, of course, from cheaper products. The iPhone 5C was coming out. That was the color version of the iPhone that came out around this time. I spent some time in my youth working in a Radio Shack store in Moose Jaw, Saskatchewan. And one of the most popular products that year was a color transistor radio that came in garish colors, blues and pinks and oranges. And it was extremely cheap and extremely popular. I think when a company like Apple starts producing its products in a variety of different colors instead of coming up with new technical innovations, it makes me wonder whether they're actually getting as much out of their R&D as they could. But that's me. You might also get a change in the cost of sales by simply having a different mix of products. So if none of your costs have changed during the year, but you are now selling more of the product that has a high margin and less of the product that is costly for you, then you might end up with an improvement in the cost of sales simply by changing what you're selling. So we can look at these sales then by product line and see if that's what's driving some of the change in the net income numbers for Apple. What have we got here? We have, again, from the notes to the financial statements, the sales broken down by product line. The last table that we looked at had the sales broken down by geographical region. This is now by product line. And you've got a line for iPhone, iPad, Mac, services, and other. This is where I got my figures on one of the very first slides, where we saw that the amount of sales for Apple in the iPhone category were 66%. This is exactly the table that I was quoting at that time. All right, so what have we learned here from this table? Again, I've done a common size and a trend analysis to try and figure things out for us. Question to ask here is, which Apple product out of all of them attracts the premium pricing? Clearly, that's the iPhone. That's the one that is the most profitable. You can see that the sales for Apple, as we know, they went up by 37% over the 2-year period, but the sales of the iPhone grew by 70%. If your breakdown of your product is becoming more and more focused on the sales of your most profitable product, then of course your cost of sales overall is going to drop. So that's partly what's driving the drop in the cost of sales. Basically put, when iPhone sales rise fastest, gross margin also rises because iPhone is one of those products that it sells that attracts premium pricing. So let's look now at the balance sheet. We've looked at the statement of operations, which gives you the picture of what happened during the year. The balance sheet is going to give us the picture of what it looks like at the end of the year. It's like a snapshot as opposed to a movie. This is the consolidated balance sheet for Apple. You'll notice it only has 2 columns of numbers. It compares 2015 and 2014. This is standard for companies. They don't always have to have the same number of columns in their financial statements. They are trying to provide the comparison that they think most people are going to find useful. You'll see it's very consistent from year to year. Every year, Apple gives you 3 columns in its income statement and 2 columns in its balance sheet. So they're not trying to hide anything. They're just trying to provide you with the information that they think is helpful for you. So what does this look like? We have 2 sections. We have the assets and we have liabilities and shareholders' equity. The asset section is everything that the company owns, and everything over here is what the company owes. So it can owe not just to its creditors, which are the liabilities, but also to the shareholders. The shareholders are not the company. The shareholders are not even the owners of the company. There's no such thing as an owner of a large multinational corporation like this. What you have is you have people who work for the company and run the company and make all the decisions. And you have a very scattered group of people and institutional investors who own the shares. But owning the shares in a company is not quite the same thing as owning a company. If you have a small privately held corporation where one person owns all the shares, then I think it's probably fair to say that they own the company. But there's nobody that actually you can point to and say, you're the owner of Apple. What you are, if you're an Apple shareholder, as I was for about a year or so, I owned, I think, maybe a fraction of an Apple share. They're extraordinarily expensive. The most you can say is that you own a share. You can't say that you own Apple. And if you don't believe that, go buy yourself an Apple share and then walk into the office in Cupertino and demand to see the boss. You will get shown the door, not the boss, because you're not the owner. You're simply a shareholder. So this comparison of these 2 categories, then everything that the company owns and everything that the company owes, is the basic thing that holds the balance sheet together. These numbers have to add up to each other. Everything that the company owns had to come from something, from somebody. Some of it is wealth that is borrowed from other people, and some of it is wealth that's been generated by the company and actually belongs to somebody else. It belongs to the shareholders. That's what the equity section is. That doesn't mean that the company has to give it to the shareholders. And this is really part of the story that's going on at Apple at this time. Anything that you've borrowed in terms of liabilities, you have to pay back to people at a certain time. There'll be a contract for the bank loan or a contract with your supplier that says you have to pay at a certain point. But the equity, although you owe it to the shareholders, you don't legally have to give it to them. You can hold on to it and use it to run the company. And that's the big difference between liabilities and shareholders' equity. So these 2 numbers then are always going to be in balance, just by definition. The assets come to 290 billion and the liabilities come to the same figure. If you look at the liabilities and shareholders' equity section, you'll see that it's broken down into three different things. You've got the debt section, which is the liabilities, and you've got the equity, which is broken into two different categories. One is the value of the shares, and the other is the cumulative earnings of the company since it started. So Apple goes way back to the late 1970s, I believe. All of the earnings since the company began are accumulated in that little section there that says retained earnings and accumulated comprehensive income. We'll explain those in more detail as the course goes on. The thing you want to notice about the shares figure there, the $27 billion worth of shares, keep in mind that that is the value of the shares at the time that Apple sold them to the shareholders. So Apple as a company is valued on the stock market at far, far more than $27 billion. I believe it might be the first trillion-dollar company, but it is an enormous figure on the stock market. But keep in mind that Apple, when it sells those shares to the shareholder, no longer owns those shares. That's the amount of money that it got when it issued them. And if those shares go up on the stock market, Apple doesn't participate in that wealth. That's the shareholders who are benefiting from that. So that figure simply represents the amount of money that Apple got when it sold the shares. So then the question we've got is, if this was all of the money that it borrowed and generated from selling shares and from retained earnings and operations over the years, what have they done with all that money? And that's what we're going to look at next. We're going to look at the assets and how they are divided up by Apple. So this is a closer look at Apple's assets. You'll see that we have two different sections. You have the current assets, and you've got the non-current assets. Binary distinction between them, very simple. This is just an accounting definition. Current assets are those assets that are either cash now or they're expected to be converted into cash during the coming fiscal year. So at the end of 2015, Apple had $89 billion worth of assets that were either already cash or would probably be converted into cash during the year. So for example, the inventory is at $2 billion worth of inventory. You would not expect Apple to have the same product sitting on its shelves at the end of next year as it's got sitting on the shelves right at this moment in time at the end of 2015. It will still have some inventory, but they will be new pieces of inventory. The ones that are sitting on the shelves at the end of 2015 would have been sold and converted into cash. The non-current assets then are all of those assets that the company has that are not expected to be converted into cash during the year. It's quite possible that you've got a factory or a truck or a photocopier that you're going to sell during the year, but you're not expecting at the beginning of the year to necessarily be selling all of those things. So that's why they're called non-current assets. I've got this kind of loose definition that I play with when I'm talking about a particular company like Apple, which has a lot of assets. And this is not a technical term. I just mean, are there any assets that are unproductive? Are they just sitting around doing nothing, or are they perhaps assets that are just in low yield financial securities that are not really producing a lot of profit for the company? I want you to try to identify, by looking at this list of its current and non-current assets, all of those things that you think are actually not producing much value for Apple. And what I'm talking about then is the cash and anything that's not actually involved in Apple's business. So for instance, inventory, I would think is a productive asset. That's what Apple sells. You want some inventory. It's property, plant, and equipment. That's a productive asset because it needs those facilities in order to produce the products and services that it sells. So all those things that I just mentioned, inventory and property, plant, and equipment, they're part of Apple being Apple. What about all those assets that Apple has that are really just Apple kind of wondering what to do with the money that it's generated from its debt and from its shares and from its retained earnings? There's one right there, cash and cash equivalents. Now, every company needs a certain amount of cash lying around in order to conduct business. You can't be down to zero, but that is $21 billion of cash and cash equivalents that is not invested in inventory, it's not invested in product development, it's not invested in property, plant, and equipment. So for my loose definition, I am going to call that an unproductive asset. Short-term marketable securities. So what's a marketable security? Those are shares in other people's companies. So Apple has a bunch of investments in the stock market that it's expecting to cash out during the coming year. That's why it's called a current asset or a short-term marketable security. If it's bought some bonds or some stocks that it plans to trade in the next year, that would be included in that category. That's another $20 billion right there. And then you have long-term marketable securities. That's the same thing, but these are the securities, the shares and bonds that it expects to hold on to for at least 12 months. Those are all relatively unproductive assets for Apple. The total, $205 billion. Now, keep in mind, Apple's total assets are only $290 billion. So 205 out of $290 billion worth of Apple's assets are invested in all that. They're just sitting in the cash drawer, sitting in the bank, or they're invested in the stock market rather than being invested in Apple and its own products and services. That is 71% of its assets. More than 2/3 of Apple's assets are not invested in Apple being Apple. I think that's kind of problematic for a company that prides itself on being innovative. Like, if it had any great ideas, why isn't it investing that money in those great ideas? I am not alone in this. There are a lot of shareholders who in recent years have complained that Apple is not doing anything with the money that it's got. It's just sitting on it. And we'll try to explore what on earth is going on there as this lecture continues, but also as the course continues. So, what have we learned? That less than 1/3 of Apple's assets are invested in actually being Apple, the technology giant. As you can see, the liability section is organized much like the asset section. You've got a current section and a non-current section. I just want to highlight these two things here, which are the long-term debt. The debt seems to have arisen just during 2014 because the current portion in 2014 was zero. So they started borrowing in 2014, the $28 billion there. And by 2015, they now have 53 billion plus 2.5 billion. So almost 55 billion, 56 billion. And the reason that you've got this current portion is that simply means it's all long-term debt, but part of it is going to have to be paid back this year. That's another standard accounting convention. You've got your long-term debt, and you typically move a portion of that into the current category to show people how much of the debt has to be paid back this year. So if you've got a mortgage on a house yourself, then you will know that there are obviously 12 months of payments that have to be made during the coming year, and the rest of it is not payable for another 25, 35, 40 years sometimes. So what have we got here? We have a total of $56 billion of long-term debt, and that figure is growing. So even though they're paying back some of the amount this year, they will continue to refinance that debt and continue to borrow. The amount of long-term debt continues to climb. The question is, why? And in particular, why does Apple borrow money if it has so much cash and all these stock market investments lying around? Why on earth does it borrow money? It makes no sense. Well, let's look at the cash flow statement and see if we can figure out some more clues to this puzzle. So the cash flow statement is a statement unlike the other two. So the balance sheet and the income statement, both of them are representing the economic value of what's happening in the company, irrespective of the amount of cash that changes hands. The cash flow statement is purely focused on what happens to the actual cash of the company. It's like looking at the company through a different lens. Like the income statement, it represents what happened during the 12-month period. The balance sheet was like a snapshot at the end of the fiscal year. The income statement and the cash flow statement show what happened during the 12 months. So how is the cash flow statement organized? Well, it starts with the cash at the beginning of the year, and it ends with the cash at the end of the year. And everything in between is explaining why there was a change in cash from the beginning to the end of the year. So if you look at this very quickly here, I just want to point out the obvious. If you look at the cash at the end of 2013, you'll see that that's the same as the figure at the beginning of the next year. And then the figure at the end of that year is the same as the figure at the beginning of the next. So there's continuity from one statement to the next. Let's look now at the change in cash during the year and how it is organized. And you'll see it's divided into three sections. You've got your operating activities, your investing activities, and your financing activities. This is normal. This is the way all companies organize their cash flow statement, dividing up the changes in cash into these three categories. And we'll be able to look during the course at different transactions that take place and be able to categorize them for ourselves. Is this an operating cash flow? Is this an investing cash flow or a financing cash flow? So what do these things mean? The operating cash flows are all of the cash that's generated or used up in the actual operations of the company. The investing cash flows are the investments that the company makes. Remember, this is from the point of view of the company. So when the company takes its cash and invests in a new asset, or it sells that asset and gets the cash back, that is an investing activity. It's not the same thing as the investors who bought shares in the company. From the company's perspective, those investors represent a financing activity. So how did the company finance its investments and its operations? So the financing is all to do with borrowing money or selling shares and so forth. Obviously, the total of the operating, investing, and financing cash flows gives you your overall change. This is a good point to just stop and think about the relationship between these three things. And the fact that you're going to expect companies at different stages of their development to have a different relationship between the operating, investing, and financing cash flows. When a company starts out, a startup company, you're going to expect to have positive cash flows from financing because it's selling shares and generating money to start up the company. And it's probably using cash in the investing and operating sections. So you'd have negative numbers there if the company was brand new. And as the company matures and starts developing its products and starts selling them and generating wealth, you're going to have positive cash flows from operating and perhaps continuing to have negative cash flows in investing as the company grows and grows and grows. When it reaches a stage of maturity, the company is going to have positive cash flows from operating, and perhaps it might tail off its investment if it's run out of investment opportunities. And eventually, as the company gets older and begins to wind down, if that happens, you're going to see positive cash flows from operating and negative cash flows from financing as it returns the wealth to the investors and pays off its debts. So that's just a normal cycle. So the relationship between those three sections can tell you a lot about where the company is at in terms of its life cycle. Let's look at the operating cash flows and just see how this is organized. This is the most complicated part of the cash flow statement, and in some ways, the most complicated part of the entire set of financial statements. So it's okay if you're a little bit confused by this. Let's try and work through this and just in general get a sense of what's happening here. What you're trying to explain is, we can calculate by looking at the bank account how much cash was generated in the company. And if you deduct the investing activities and the financing activities, you'll have a remainder that has to be the cash that was generated by the operating activities. So it's not necessarily difficult to calculate that amount. The question is, how do you explain where that money came from? What part of your operations generated the cash? So there's two ways of doing that. The way that's not shown here is the direct method, which simply tells you category by category where the cash came from in each of the different parts of the operations of the company. We'll look at examples of that during the course. But this is the more common way of doing the cash flow statement. Why is it more common? I'd say it's just convention. This is the way that people have been doing it for years. What you're trying to do is reconcile the income statement or the profit and loss statement to the cash flows that are generated by the operations of the company. So you start with the net income figure. The net income figure, if you were to look back at the income statement, you'll see that that $53 billion figure is precisely the net income during 2015. So you start with that number and you try to adjust that to reflect what was the actual cash generated by the operating activities. So stop and think about that for a second. The net income is the economic value that was generated by the operations of the company, right? That was the statement of operations. So that's an economic value. That's not the same thing as the cash that exchanged hands during that 12-month period. Let's just try to work backwards from that then. The net income, if you look back at the income statement, you'll see that there was a lot of expenses deducted from the revenues to end up at net income. And some of those were expenses that actually had nothing to do with cash. So this is the first set of adjustments that you make in the operating cash flow section is you take your net income and you add back to that any deductions that you made on the income statement that weren't actually cash expenses. So depreciation and amortization are the cost of the fixed assets of the company that's simply been allocated to that fiscal year. So those fixed assets would have been paid for years ago when they bought the factory, or they bought the photocopier, or they bought the truck that they use. And the cost of those then gets spread out over the time that you use those fixed assets. That's what a depreciation or an amortization expense is. It's not a cash expense, it's simply an allocation of an earlier cash expenditure to this fiscal year, saying that that net income wasn't free. That net income depended on having made an investment years before. In this case, $11 billion worth of investment is being allocated to the wealth that was generated during 2015. Share-based compensation expense is a non-cash expense. We'll get into equity compensation for the CEO and the CFO and the chairman of the board and so forth during this course. It's a topic that interests a lot of business students because one day you'd like to be paid in that way as well. So we'll try to understand that as best we can. It's pretty complicated, but certainly not beyond our comprehension. But let's set that aside for now and come back to it later in the course. Same thing with deferred income tax expense, a complicated topic that we can come back to. But suffice to say that all three of those numbers are expenses that were deducted in the income statement that actually didn't involve cash. So let's add those back. So if you take the $53 billion and you add the 11, 3, and 1 there, you're going to be up to what, 64, 65, closer to $70 billion worth of cash. But then you also have to take into account that a lot of the stuff that's involved in operations is stuff that's on the balance sheet in the current assets and the current liabilities section. So you have changes in these categories. You're going to see an impact on the cash of the company. So let me give you an example of that. If you were to start with $1,000 worth of inventory at the beginning of the year, and at the end of the year, you had $2,000 worth of inventory, that would indicate that despite anything else that happened during the year in terms of selling product to customers, you spent an additional $1,000 on your operation in order to get more inventory. So that would have been a use of cash in the operating activities to build up your inventory for operational purposes. By the same token, if you had $1,000 worth of inventory to start with, and at the end of the year you had only 500 left, you would have generated an extra $500 worth of cash by selling that inventory off. So these changes in working capital, the changes in the current assets and the current liabilities, need to be taken into account if you're going to reconcile the net income number to the actual cash that's generated. Keep in mind that positive numbers here mean an increase in cash from operations, and negative numbers indicate a use of cash. So what do we see here? The operations generated a ton of money up until the point where you start looking at the changes in current assets and liabilities. Inventory, for example, went up slightly from one year to the next. That's a negative number, right? So cash was used to build up that inventory. And if you want to look at the inventory numbers for 2014 and 2015 and compare, you should be able to see that inventory rose slightly. The same thing with receivables, right? So there's an increase in receivables, meaning that they made sales to customers, business to business customers included, and collected $3.7 billion less from the customers than they actually sold. So their accounts receivable went up during the year by $3.7 billion. That's a pretty big increase in accounts receivable and a pretty big loss of cash to them. However, accounts payable is a positive number. So what does this mean? Accounts payable is the number that you owe to your suppliers. If that number goes up during the year, that's an increase in a liability. So you have basically increased your accounts payable and been able to save paying $5.4 billion to your suppliers during the year compared to where you started. You're going to have to become comfortable looking at these changes in current assets and thinking them through, because that's probably a question that's going to come back to you during the year and possibly even on the exam, trying to understand what is the cash implication of an increase in inventory or a decrease in inventory, an increase in accounts payable, a decrease in accounts payable. It's just worth working through for yourself how to think about that so that you're comfortable understanding what a negative number and a positive number mean in the operating cash flow section of the cash flow statement. So that's our figure that we're looking at, $81 billion. a vast amount of wealth by anybody's standards. So let's look at how that compares to the other sections of the cash flow statement. Here's the investing section of the cash flow statement. So the investing activities, as you can see, are the things that the company does with its money in terms of investing in long-term assets. Now, some of these things are negative numbers, right? So purchases of marketable securities, that's a negative number. Remember, we're on the cash flow statement. So a negative number means a use of cash. So the company used $166 billion to buy marketable securities. It also made a smaller investment in business acquisitions. So isn't that interesting, right? So you're talking about Apple, which is a company that is constantly on the lookout for startup technology companies that it can acquire and incorporate. For example, the Beats company with its headphones. The net business acquisitions of the company were only $343 million during the year, compared to $166 billion that it spent just investing passively in the stock market. That does not indicate to me a company that's really focused on identifying and acquiring new technology opportunities. Either that, or they are focused on that and they're simply not able to find them, which is another problem that could be behind some of the numbers we're seeing here. So Apple has got no problem finding stocks and bonds to buy, but it's got a bit of a problem finding new businesses that it could purchase. It did, however, invest $11 billion in property, plant, and equipment. So this would be opening new factories and so forth, new stores. And it also acquired some intangible assets. So, for instance, if you are Apple and you bought Beats from Dr. Dre, then you are going to pay a certain amount of money for the use of the brand name now. So that's what an intangible asset would be when you acquire it. I can ignore that very small number. But the point here is that these negative numbers represent the fact that Apple is using cash to buy assets. What about the positive numbers? Let's look at them. You have the proceeds from the maturities of marketable securities and proceeds from sales of marketable securities. So the only positive numbers here that are generating cash in terms of the investing section of the cash flow statement are to do with marketable securities. So when you buy marketable securities for 166 billion, you sell a total of 121 billion dollars worth of marketable securities for a net investment. The difference between maturities and sales, sometimes when you buy a bond, it's got a fixed term on it, so a 6-month bond or a 3-year bond. When that term expires, you turn in the bond, you get your money back. You don't have any choice over that. That just happens. The security matured. So that's what that category is about. All of the other proceeds come from the sale of marketable securities. So the decision to sell a bond before its maturity date, or the decision to sell a stock in another company, which does not have a maturity date, all of that would be in the sales of marketable securities line. All right, so selling assets generates cash. And the net overall amount then is $56 billion that Apple invested during the year. So a negative number. So it used $56 billion worth net of cash to invest. And almost all of that went into the stock market, just a small amount into property, plant, and equipment. The final section of the cash flow statement is the financing cash flow. So this is all of the relationships that the company has with its investors and with its creditors. What was the net effect of its transactions with those entities in terms of cash? So what have we got here? We got some very small figures here. Apple issued some shares to its executives. So there's some positive numbers that it got in terms of selling shares, but a lot of the use of cash there was the tax that's paid by the company in order to provide shares to its executives. Obviously, when the company issues shares, it has a tax liability that it has to settle with the federal government in the United States in order to issue those shares. So the net effect is slightly negative there, I think. Yeah, slightly negative. The company also paid dividends, $11 billion worth of dividends, and it repurchased some shares. So although it issued some shares to its executives, most of the activity in the stock market for Apple was actually to buy back some of its shares. So this is kind of curious, right? You think of companies issuing shares in order to raise money. When you've got a company like Apple, which has tons and tons of money, one of the things that it can do with its cash is to buy back shares on the stock market. And this is a very, very contentious move by the company. You can read up on that on my website. You can also look up news articles on it yourself. In some ways, repurchasing shares is an alternative to dividends because when you pay dividends, all of the shareholders will get those dividends regardless of whether they wanted the money or not. Why might you not want the money? You might believe that Apple should hang on to its cash and invest in new products. If you're an Apple shareholder, you might not want Apple to give the money back. You might want it to go on being Apple. So if you're in that category, you don't want dividends. But if you're a shareholder that believes that Apple's got too much money and should be returning some of it, you would welcome the dividends. But dividends get paid to all the shareholders regardless. Share repurchases then is a way of returning money to the shareholders that gives them the option of taking it. So by going to the stock market and saying, we're going to buy back $35 billion worth of shares, anybody who wants to sell those shares back to Apple can do so. And those people that would rather hang on to the shares can hang on to them. So in some ways, this is a very democratic way of returning money. People can decide whether to take it or not, or whether to let other people have it and hang on to their shares instead. What's contentious about this, of course, is that it reduces the outside ownership of the company and increases the percentage of the company that's owned by the executives and by the senior members of the board of directors. And if you were to do some investigating, you'd find out that the two biggest shareholders, individual shareholders of Apple, are the CEO and the chairman of the board. So, repurchasing shares in some ways suits them because it gives them a higher stake in the company and even more control and less scrutiny from outside shareholders. So this is why it's contentious for the company to be repurchasing its shares. There's some good things about it in that it allows investors to choose whether to take the money or not. And there's some questions about whether it's, well, I don't know, abuse of power might be taking things too far, but certainly it suits their interests to consolidate their hold on the company to a certain extent as the largest shareholders. The last section of the financing cash flows section of the cash flow statement is the borrowing of money. As you can see, you've got $27 billion worth of proceeds from long-term debt net. Now, we saw that earlier when we were looking at the balance sheet, that there was that change. Change in commercial paper. Commercial paper is just another debt instrument, which you can read up about on, well, just go check Wikipedia or the textbook. So these are both together almost $30 billion worth of cash that the company borrowed in order to pay the dividends and repurchase its common stock. So that's a real conundrum. Apple has tons of cash and tons of marketable securities that it could have used in order to return money to the shareholders through dividends or repurchasing of stock. And yet it chose to borrow money and pay interest on it in order to do that. If you want to find out more about why it did that, I can't get into it in an introductory lecture, but you can check out my website, Fearful Asymmetry. The link is there, where I delve into Apple's situation in some considerable detail. Short answer, TLDR, is tax. Let's see if we're ready to draw some conclusions about Apple. We've finished looking at the financial statements for 2015 for Apple, and we've been doing that in order to try to get some clues about this question we started with, which is why did Apple's sales drop in 2016? So what have we learned? We've learned that Apple is over-reliant on its cell phone sales. In many ways, it is a cell phone company now. The iPhone provided most of the sales and most of the sales growth during 2015. It's hugely profitable, but this leaves the company exposed to competition. And looking back now on what happened in 2016, we know that the company began to run into competition from Android and Huawei. We also saw in 2015 that the company had excessive amounts of what I've called unproductive assets. So the cash that's not invested anywhere and the marketable securities, which represent Apple simply investing in the stock market because it doesn't have any products or factories of its own to invest in that are going to generate more wealth for itself. Adding to this or compounding the problem is that the operations that they do have do generate vast amounts of cash. But rather than being a source of joy for the company, you actually end up compounding the problem because you've got even more cash that then has to be invested in the stock market in order to park it and at least earn some little return, as negligible as it was during that period of time. Now, Apple has no new ideas because, well, despite all of its expenditures on R&D, which we saw on the income statement, it has come up with no new products of any consequence to invest in since 2010. So 2007 was the iPhone, 2010 was the iPad, the iMac was back way, way earlier than both of those products. The only new products that it's come up with, it's either bought from somebody else, like the Beats headphones, or it has come up with these great brainwave ideas that it's announced to great fanfare, like the Apple Watch, that ended up just dying in the marketplace and doing nothing for their bottom line. So the company has really struggled for many years to come up with a new home run product to replace the iPhone and the iPad, or to add to the iPhone and the iPad. And lastly, we saw in the 2015 financial statements some clear indications that the company was unwilling to use cash to pay the dividends that it was paying to its investors. Both the dividends and the share repurchases were financed largely by borrowing from the bank rather than using the cash that it had. So that becomes a bit of a side problem, perhaps unrelated to the sales drop, but um, perhaps not. Maybe this whole focus on tax, which I describe in my website, and on the repurchase of shares and the paying of dividends, maybe that becomes a bit of a distraction for the company's leadership, and they have taken their eye off of the ball, perhaps. This is just a hypothesis, but all of these things together suggests that the company is not as focused on new products and new product development as it might be, despite its vast expenditures on R&D compared to many other companies. So let's just check the insights that we got. One of the things you want to do when you've done this kind of analysis is to recognize that your financial statement analysis is really the beginning of the inquiry. It is not the end of the inquiry. So we have developed some tentative hypotheses about Apple's tax situation and about its product development, about the competition that it's receiving from outside of its own sphere of influence. So companies like Android and Huawei are going head to head to a certain extent. You've got competition from Samsung, which is quite curious because Samsung is actually the largest supplier of parts to Apple. It makes all the chips that go into the iPhone. So you've got these things going on outside of Apple that are worth paying attention to. You can't simply come to firm conclusions just by looking at the financial statements, although they do give you all kinds of clues as to where to look. So if we were to look outside the financial statements for other evidence, what are the things that we know? Just off the top of my head, these are not the most important things that you could discover by digging deep. There may be other things going on, but the most obvious things then, the death of Steve Jobs in 2011, that might be what's behind the loss of creative drive at Apple and the loss of new products to bring to market. You could do a market analysis of the cell phone market and maybe try and quantify just how much competition you're getting from Android and Huawei and where that is coming from. Obviously, the rise of Huawei as a global competitor is affecting Apple in the one area where it mattered the most, which is the growth of iPhone sales in China. That was its most profitable product, growing in its fastest growing market. And then Huawei comes along and begins to dominate that market in a way that is going to be a setback for Apple, no matter how you look at it. And then you have the distraction of all the tax issues, which I suggested might be causing problems for Apple's leadership. On top of that, if you were to look at the news in August 2016, there was a surprise tax bill from the European Union for Apple, claiming back taxes that Apple had unfairly avoided. So all of these things become problems that are perhaps taking Apple away from its focus on product development and sales. But you also want to look for contradictory evidence. You can't just look for evidence that backs up the insights that you've got. I would suggest that you give some thought to this yourself. Where would you begin to look for contradictory evidence? Where would you begin to look for evidence that Apple was actually succeeding and that this drop in sales in 2016 was just a blip? Where would you begin to look for information on that? How would you go about building an alternative interpretation of the financial statements? I've taken these financial statements from 2015 in one particular direction to try to show some of the problems that are lurking behind them. But Apple is a very complicated company, and there's all kinds of good news going on there as well. So you could build a fairly persuasive argument in the other direction if you're able to back it up with evidence from the financial statements and from outside the financial statements to come up with a different interpretation. And it's obvious that people do come up with different interpretations because some people buy Apple shares in a given day and other people sell Apple shares in a given day. reflecting different beliefs about where the company is going. So all of this is to say that financial statement analysis is an intriguing start to understanding what's going on at a company, looking at the economic evidence that the company itself provides, beginning to think critically about it, and beginning to try to call into question the interpretation that the company is leading you to take from that information. You are in charge of creating meaning from those financial statements for yourself. You can't simply be a passive reader of the financial statements and accept the interpretation that the senior managers of the company would like you to take from it. Let's summarize what we've learned so far. We've looked at Apple's income statement, balance sheet, and cash flow statement. We have learned, I hope, how to read these statements at a basic level and to see how they're connected to each other. The most important thing for me is that I hope that this set of slides has helped you begin to think critically about financial statements and not be a passive reader. So I look forward to what we're going to cover in the rest of this course, and I hope you enjoyed this presentation. Bye now.
Well, it's all about money, money, money. Ooh, money, money, money. Ooh, yeah. Dollar signs in your eyes. You only wanna make yourself some